Rick Rule speaks about silver investing in 2021 and gave his outlook on silver short squeeze, Basel III, India's tax cuts, banks, and much more. Addressing the uncertainties about silver metal, Rick said that there's a caveat. The prices of precious metals vary with a lot of factors, but the most important is nominal and the real interest rates. The increase in at least nominal interest rates on the US 10-year treasury has been damaging to precious metals prices. If one looks back over the last 3 years, the decrease in the yield on the US 10-year treasury from 225 basis points to 60 basis points corresponded very neatly with the increase in precious metal prices, and hence the increase in prices and precious metal equities. The increase in the interest rate from 60 basis points to 75 basis point corresponds very neatly with the plateauing and then decrease in precious metals price to the extent that the strength in the US economic recovery allows the Fed to in turn allow the interest rate to increase a little bit more, which they want to do, if for no other reason than it gives them the ability to cut interest rate if they need to goose the economy, if they don't engage in the near term in yield management, which is to say sell short term notes and use the proceeds to buy a long-term note and bring the 10-year rate down, you will continue to see precious metals price softer in the near term. They will correspond inversely with the nominal interest rate on the US 10-year treasury. So beginning a discussion of silver begins by saying that in the very near term, there's potential downward pressure on the silver price as a consequence of interest rates, and traditionally to the prices of silver equities magnifies the price of the commodity. Rick also believes in the diversification of the portfolio. He said that in a market where precious metals and natural resources are out of favor, which they are not now in a bear market, you can allocate it as much as 40% of your portfolio to precious metal and natural resources. You scale down the proportion of your portfolio involved in natural resources and precious metals inversely with their popularity in the market. The necessity of maintaining more liquidity than one normally would right now. It's painful to do because the liquidity that you maintain in conventional short-term savings accounts pays you a negative real yield. This is to say, it costs you purchasing power every month you maintain the liquidity. If you look at the negative yield, what you understand is that you are paying an options premium, in effect having the cash, having the short-term liquidity. If we experience a liquidity decline in capital markets, a 2008 style decline, which we might not, but we could, having cash then gives you certainly the tools and hopefully the courage to take advantage of that decline rather than being taken advantage of by the decline. And the diversification among other asset classes, particularly if you are willing to study something about those asset classes and have an understanding of why you are investing in them, is very worthwhile. Often people who buy into the natural resource narrative take it to an illogical extreme, and that's very dangerous. They are often too, particularly when they are young, drawn to the spectacular upside in natural resource equities, and as a consequence of that take too many risks. What's most important at any large financial services firm isn't even shareholder return. It's a quarterly cash bonus for senior executives. Rick explains that silver underperforms gold in the first half of a precious metals bull market. Gold moves first. It's the fear of buyer that actually moves the gold. When the momentum is established by gold and that price momentum reinforces the narrative in people's mind, then silver moves. And when that occurs, silver moves both faster and further. If that is true, we are approaching silver's time as per Rick. The bull market in precious metals is very much intact, that we are currently experiencing a cyclical decline in a secular bull market. That is a consequence of a relaxation of the war against higher interest rate. As the interest rate increase subsides, that precious metals will resume their upward march and that silver will more likely than not outperform gold. About a month ago, news about India also hit the market, where we saw the Finance Minister Nirmala Sitharaman reducing import duty on gold and silver to 7.5% from 12.5% in the Union budget for 2021 to 22. This will make gold and silver cheaper for consumers at home and make jewelry exports more competitive in global markets. However, Rick Roll doesn't think this will have too much influence on gold and silver prices. Rick said that the Indians cut the excise tax because it wasn't working, and it wasn't working there because their customs service is so corrupt. The Indian government recognized the facts, which is to say that people on the subcontinent are attracted to storing their wealth in gold and silver rather than in rupiah. If there is demand for a product, the government can charge a tax, but the people aren't necessarily obliged to pay it. There are hundreds of sailing vessels that depart Dubai every day, and there are hundreds of vessels that depart Gujarat every day. And it's possible that somewhere in the Indian Ocean they meet, and that the vessels that go back to Dubai have rupiah, and the vessels that go back to Gujarat have gold and silver. This has been going on for a very long time, and while it might not be something that the Indian government has a sense of humor for, the Indian people have a deep and abiding sense of humor for it. Now explaining how will Basel III influence the price of precious metals like gold and silver. Rick said that depending on how the regulators decide to allow or not allow gold to figure in bank capitalization will be important in the near term. Ultimately, what you are seeing over the next decade is gold becoming private wealth rather than a reserve asset, and ultimately that gold will be a form of disintermediation, a form of you taking control of your savings and controlling your wealth, so that ultimately you will have control. You colloquially over the gold price and the banks won't. But right now, gold is a very important reserve asset, and the way it's treated for accounting purposes in Basel III, the way it's discounted or not discounted, the way it's treated as a tier 1 asset or a tier 2 asset or tier 3 asset will be very important. The banking community itself has mixed interest. There are some bankers who regard gold as a very good asset, and there are some regulators that regard gold as a very good asset, and they would like the regulations to encourage the ownership by financial institutions, particularly depository financed institutions, of an asset that has the durability that gold has. Other interests suggest that gold doesn't pay a particularly good yield, although the policy rates on gold are substantially more attractive than the lease rates on deposits. The idea that gold doesn't have a yield is completely wrong, but that notwithstanding, that's an esoteric discussion. There are lots of different interests at play in the discussions around Basel III, and that it's difficult to understand the likely outcomes relative to everybody's interest in the political nuances. So guys, let me know what do you think about this video. Also, if you found this video really informative, then please press the like button, subscribe to our channel. I'll see you in my next video. Till then, enjoy your day.